Yo guys, what is good? I hope you're all doing absolutely amazing and are trading safely in the markets. It's finally your boy VGOK and I'm back
One eternity later
with another video for you guys today. Now, before we get into anything, I want to just apologize because I know it has been, 2 months since my last video. Yep, I've fallen off a little bit. I've procrastinated a little bit on getting these videos out for you guys, but I've finally been able to get this one out now finally for you. So I hope you guys really do appreciate this video, and it is one of the most highly requested videos that I've seen. But I'm gonna try and make a promise to you that I'm going to try and be more consistent in my uploads for these videos. And also another part of it is, I'm not a perfect trader by any means necessary. I'm not a perfect trader at all. And truth be told, I had quite a bad losing run of trades, and had me sort of feeling all over the place, had my emotions in there, and I lost one or two funded accounts which I'd secured, so I was kind of feeling a bit like this.
No, God! No, God, please, no! 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 No!
And eventually I was just like this. But I'm now back. I'm trying to create more content for you guys, so yeah, please do drop in the comments below anything that you guys want to see from me, any sort of video ideas that you have that you want me to sort of create for you, and yeah, I'll take a look at those as well. But for today's video, and like I said, it's been one long in the pipeline, and it's all about looking at exactly what the smart money mindset exactly is. Who are the largest market participants in the FX market? Who are those market makers that trading against us? And obviously, how do they actually manipulate the markets? We're going to be looking into that in a lot of detail. We're going to be delving into the actual manipulation candles themselves, which go by many names in the industry. Such as institutional candles, order blocks, bankers candles, punch candles. There's all sorts of names for them out there. But the main thing to realize is that they all mean the same thing. Before we get into the thick of it all, I just want to make it clear that in trading, there's no actual perfect strategy. And by all means, smart money concepts, institutional trading, whatever you want to call it, it's not the perfect way to trade. There is no perfect way to trade. There's no perfect strategy, I should say, in trading. There are many other profitable retail methods of analysis as well that are profitable, and they do work. Now, personally, the reason that I choose to trade using smart money concepts is because I love the degree of precision you can actually achieve in the trades, which lets you have such a minimal stop loss, and you can have such large risk to reward ratios. And of course, by having being able to achieve these high risk to reward ratios, it gives you a higher margin for error, so you don't actually have to be as accurate if your risk to reward ratio is going to be that high, 1 to 5 plus. Now, when it comes to smart money concepts, it's best to think of it more of as a mindset rather than a rule by rule strategy. Think of it as a way to interpret the data and information given on the charts. When you're analyzing, you don't really want to be emotional or impulsive. When you're trading, when you're analyzing, you want to be reactionary to the data. So, whatever moves that the markets make, whatever structure breaks, whatever happens in the market, whatever happens on the charts, you'll be able to react accordingly to that. Now, also, here's some key points or facts, if you will, that we should really sort of know, that we need to consider before we go any further. Now, firstly, we need to realize who are the main movers of the markets. You've got the financial institutions, the banks, and the hedge funds. They're going to be the people that are making those larger moves in the market, the ones that can have more market share within the FX market. Secondly, understand that they can manipulate the markets for their own financial gain by stopping out the retail traders and freeing up more orders. And those orders, they can be pending orders, they can be stop losses, they can be take profits. Consequently, once these get triggered, traders are exiting out of the market. Now, retail traders, they generally trade in similar ways. They use very, common tools, similar tools, such as, support zones, resistance zones, trend lines, and chart patterns. Now, because of this, a lot of retail traders' stop losses, they build up in a common area. Now, once the larger market participants, the banks, the hedge funds, once they realize this, they are going to be targeting those price regions to really liquidate the retail traders out of their positions and trigger their stop losses or pending orders, or those free orders that are sort of bunched up in that same area. Now, before we actually get fully immersed into the manipulation in detail, I just want to reiterate how the banks can actually get away with manipulating the markets like this. Now, what we can actually see here is the top 10 largest banks that operate in the FX market, and essentially how much percentage share, how much market share they have. Now, we know that in the FX market alone, the daily volume, each day $6.6 trillion is traded every single day in the FX market. And from what we can see from the table, so what we've just seen in this table right here, we can see that the top bank, JP Morgan, they have roughly a 10% market share, so they can control 10% of that daily sort of volume that's being traded in the FX market. So what that means is they actually can control roughly $660 billion every single day, which is obviously 10% of $6.6 trillion, which is an absolutely phenomenal amount of money. Okay, so keep that bit of information in your minds now, whilst I divert your attention to this article. Now here it says Barclays, Citigroup and JP Morgan are fined $1.2 billion for FX rigging. And then it also goes on to say a similar case with the US regulators is ongoing, where Barclays, BNP Paribas, Citigroup, JP Morgan, Royal Bank of Scotland and UBS have entered related guilty pleas and been collectively fined more than $2.8 billion. Now, I really just want to highlight the fact that they have been fined collectively. That's the key word, more than $2.8 billion. Now, what we deduced earlier, what we found out earlier, that JP Morgan, which roughly has 10% market share of the FX market, they roughly trade $660 billion per day, based on the rough estimate of obviously their 10% market share of the total daily volume. So you can clearly see that a measly collective fine of roughly $3 billion, it's a mere drop in the ocean for them, as they control such a large volume of capital per day. Compared to 660 billion they're making a day, they get fined roughly $3 billion, if that. And that just goes to show you why they keep getting away with it, why that manipulation physically exists in the market, because the amount they're being fined just does not compare to the sheer volume of capital that they have control of per day. Now, moving on to manipulation in detail. Now, compared to the average retail trader like us, the banks, they actually trade with much larger lot sizes. Now, this means that they can't just market execute like us on their positions. Otherwise, the charts would just be extremely volatile, moving up and down constantly, and they'd be looking absolutely crazy like this. So, markets just moving constantly up and down like this, like this, like this. There'd be no real good trading opportunities for us to take. So instead, in order to move price, where they want to, i.e., manipulating the markets, they must buy to sell and sell to buy. Essentially, they need to hedge themselves into their positions to ultimately, maneuver the price to their desired levels. Now, by doing this, certain candlestick formations are created. Now, like I said earlier, these formations are known to have many, many names, such as institutional candles, FU candles, punch candles. But for argument's sake, I'm going to be referring to them as manipulation candles. Now, these manipulation candles, they will give us our entry areas. So as you guys can see from these little images that I've drawn out for you guys, just for, obviously it's not going to look exactly perfect like this on the actual charts themselves, but just for the theory side of things, just to obviously get the understanding there, You know, we can see the support levels, and we can see the resistance levels, and then obviously the manipulations that happen on those levels. So obviously on here we've got the sell to buy movement, and right here we've got the buy to sell movement. And when you start to see these things, when you start to train your eye, you know, in the markets, you'll start to see these more and more often, and it'll be a lot easier to identify these sort of candlestick formations. And also something I want to sort of mention is, you know, it doesn't always need to be one massive bullish candle after the sell, or vice versa. It doesn't have to be one massive bearish candle after the initial buy up. You know, it could be and that goes the same for the first candle as well. You know, the one that goes above the resistance level or the one that goes below the support level. They can be a series of consecutive candles. So it could be a consecutive couple sell candles before it really shoots off, or it could be consecutive up candles, you know, in the moment it does shoot off. So, you know, just for argument's sake, I've done it as one candle here just for understanding of the actual theory itself. But in reality, when you're actually looking at the charts, more often than not, you'll be seeing, you know, consecutive bullish candles before a big drop, or consecutive bearish candles before the big rise. Now, how is it that we actually know where these manipulations are going to be? Now, this is where the whole concept and the whole idea of liquidity comes into it. Now, first of all, before we head into all of that, what do we mean by areas or zones of liquidity? Now, you've probably heard me talk about or mention the term liquidity hundreds and hundreds of times in my previous videos beforehand. Now, when you actually see a zone of support or resistance, so let's imagine this purple zone that I've drawn right here is our zone of support. So you'll see multiple rejections of the support zone, something similar to this. So, you know, you'll see quite a few rejections from the support zone. Now, from this, two schools of thought, or analysis I should say, usually start for retail traders about now. So you've got traders that will see, you know, the first 2 or 3 rejections of the support zone, and in their mind, obviously from their analysis, they're thinking, okay, this zone is holding, this zone is sort of holding, and you know, we're not going to be breaking through it, and we're going to be sort of bouncing off of it and going higher. And because of this, they'll be placing, you know, further buys from that zone. You know, they're imagining that price is going to, you know, hit the zone again and reject up, you know, so they can profit to the upside. Now, you've actually also got traders trading in the opposite direction, attempting to trade, you know, the breakout of this support zone. So as price will drop, you know, break out of the support zone, and then, you know, retest it as it becomes a new resistance zone, and then, you know, they'll be looking to take profits, you know, as price declines to the downside. Now, what this does is that an area full of orders is now created. As you guys can see from the 2 positions, you know, you've got the people trading the breakout of the support zone, and you've got people trading the rejection of the support zone as well in these 2 sort of positions. Now, if you look at around the support level itself, you can see the buildup of orders that have started to sort of, you know, accumulate in this area. You know, you've got the sell stops, you know, in this area here for those breakout trades, plus also the stop losses of those breakout trades. You've also got the reversal trades, so you've got the entry for the buy limits, and you've also got the stop losses for those consequent trades. So obviously, as we've just explained, you know, some are stop losses, some are limit and stop orders, so pending orders as well. And, you know, we're going to have obviously a lot of orders built up in this area. So we've just seen, obviously, for an area of support, you know, what sort of retail traders, you know, mindset is going to be going through. And the same can be said for an area of resistance. So see when the price rejects a zone from the top, so, you know, you'll have a couple rejections from the resistance zone like this. You know, you'll have your retail traders formulating their analysis based on this resistance zone, that you know, there'll be a further rejection of the zone so they can profit to the downside. So in this case, there will be sell limit orders with the stop losses, and you'll also have the opposite happening as well. You know, the breakout of the resistance zone, and then, you know, it retesting resistance and then continuing to the upside. So, you know, you'll have traders with that sort of mindset, that sort of analysis going on in the head, and obviously that will be looking to trigger those buy stop orders with those consequent stop losses with those trades as well. Now, of course, it's all well and good knowing where the orders are building up, where the liquidity levels are building up, and obviously, when you're analyzing on the markets, areas of liquidity are going to be those, areas of equal highs or equal lows, the areas where you see constant rejection from, a common price region, i.e. a support or resistance level. And obviously from what we deduced earlier, we know that smart money, we know that the large market participants, they like to target these areas. They like to target these liquidity areas, where all the orders build up. So in this case right here, when you have a common area of rejection from a resistance zone, an area of liquidity, an area of equal highs, whatever you want to call it, and then you've got the orders building up like we've just discussed right here in these two sort of theoretical positions we've drawn out to obviously show the retail sort of mindset. Then I've just drawn on, obviously the standard buy to sell manipulation, which we talked about earlier on. And in that buy up, you can see that, you'll be having those sell limits triggered, obviously orders being freed up. And also as it reaches to the top of that, it'll be taking out the stop losses as well. But as that stop loss is taken out, obviously the buy stop orders are also triggered as well. And then with that buy to sell movement, that big sell movement down, that obviously triggers the buy stop orders stop losses as well. So you can see both of these sort of traders have been taken out of the market through this buy to sell movement. And of course for the opposite side, I'm going to draw it in just so you guys can see, and we'll obviously go through some chart examples right at the end. You've got the constant rejection of this support zone, and then we have that typical sell to buy manipulation which we were talking about earlier. And as you can see, that sell, it triggers those buy limit orders in, and it also triggers their stop loss as the sell happens. And then the consequent move up, so the buy part of the sell to buy, it triggers the obviously the sell stops and their stop losses as well. So you can see obviously through this buy to sell and sell to buy movement, you can see how the larger market participants, banks, hedge funds, the market makers, essentially how they can manipulate the markets and manipulate retail traders out of their positions. So moving on to mitigation. Now after the manipulation has happened, so obviously the buy to sell or the sell to buy, as you can see, just imagine to yourselves in the buy they're opening, say 100,000 lots, just for argument's sake, buy 100k lots in the green candle, obviously, so the bullish candle, that's what they're sort of looking at doing. And then in the sell, they're looking, say, just for an example, we'll say sell 1 million lots. Obviously that's not accurate to any sort of degree, it's just sort of me getting this across just so you guys can understand from a theory perspective of what is happening in these manipulations. So obviously if they're buying 100k lots and then selling 1 million lots, at the moments where they bought at, understand that the current market price is now down here. So those initial buys are in hella drawdown, they're in a lot of drawdown. And obviously, with the banks and hedge funds and market makers, they never really lose in this market. They never really sort of lose any money in this market because of all the manipulation. So they'll cause price to come back up. And as it revisits that area where they initially bought at, that this is the moment where they're going to be looking to break even on those initial buys. So as price comes up, they're going to be breaking even on those initial buys. And then this is where sort of us as smart money traders, smart money concepts traders, institutional traders, whatever you want to call it, this is where we look to enter our positions. So in this moment here, we'll be looking to enter our sell positions as market will go to the downside. So we'll be looking to trade those positions to the downside like that. And consequently, same sort of thing in this example right here. Imagine that you have, say 100k lots on the sell, and obviously on the buy, just for argument's sake and for ease of numbers, we'll say 1 million lots on the buy. So they're in 100k lots worth of their trade in drawdown as the price is here. Imagine entering a sell position here and market just shoots up. You're gonna be vexed. So obviously, because they never really lose, what they do is they return price back down to that first region where they started selling at. This is where they break even on those initial sells, and this point is what is called a mitigation point. And at this point, obviously, this is where we look to place our buys, at this moment we're having our buys, probably at the open of that manipulation candle, with stop losses just below that candle, and then obviously we'll see price go to the upside and we look to trade that bullish movement right there. So, and right here I've just put a little summary page so you guys can really come to terms with what kind of sort of manipulation candles, institutional candles, whatever you want to call them, what they're going to be looking like. So obviously the ones that we just gone over is the buy to sell candles and the sell to buy candles. These other four that I've put down as well, they are also a form of institutional or manipulation candle. This little sell movement here before the buy is another version of this sell to buy, with just a rally of price going higher. And obviously I've called it here a rally based rally, and obviously the opposite of that, we've got the drop based drop. It's just another rendition of this buy to sell with another drop before it, a drop based drop. They're also sort of referred to, if you're familiar with the Wyckoff terms, and I'm going to be going through Wyckoff analysis in a lot more detail in a future video, so please bear with me whilst I sort of prepare all these videos for you guys. But in terms of the Wyckoff sort of terminology, the rally based rally is often referred to as a reaccumulation. The drop based drop is also often referred to as a redistribution, and of course we've got the drop based rally, and obviously that's also known as just an accumulation of price. And the rally based drop is what's known as obviously rally based drop, RBD, is what's known as the distribution of price. Now in these last two, I've put the two bases right here as two opposite sort of colored candles, but that doesn't mean it has to be a green and a red, or it doesn't have to be like a bullish and a bearish candle as the base. It can be a collection of for me personally, I like to look at max five sort of little candles as the base, and it doesn't mean that they have to be alternating, like bullish bearish bullish bearish bullish bearish. They could be sort of two bullish candles, a little bearish candle, and then the rally, or it could be a lot of rendition. And that goes for the same for these two as well. It doesn't have to be an alternate sort of candle in between. It can be obviously if it's up to 5 candles, you can have 5 little bases in there. So maybe have a couple bearish bases, a couple bullish bases, maybe some dojis, showing that indecision in between before it really goes on, rallies on again. And the same for that drop based drop as well. But if you do want to have another look at these sort of manipulation candles, then please do have another look at the supply and demand video that I posted previously, for obviously a better refresher on all of these 4 types of manipulation candles. So as promised guys, I'm gonna get into the chart examples right now, and I've got about 5 or 6 different examples of where we've been able to see where liquidity is built up, seeing where obviously it's been swept, been taken out by that institutional candle, that manipulation candle, and then obviously we're going to be having a look at how we could sort of get to our mitigation point, which is obviously where our entries are going to be. So the first example I've got for you guys, and as you guys can see on the screen right now, is a GBP USD example. This is a buy scenario, and the actual price action that we're going to be looking at and studying is from the 28th of Jan, so it's not too long ago from now, about a month ago. So you guys can go ahead and still study this price action for yourselves. So as you guys can see, this black line that I've sort of drawn out is depicting where we've got those equal lows. So the support zone, we've got those constant bounces from this support zone. So you got 1, 2, 3 bounces on the support zone, and that's building up that liquidity. You can start to see, from a retail perspective, they'll be looking at this and thinking there's a W pattern forming, equal low. Then as we come back to the zone once more, we can see that these consecutive 2 bullish candles, they push down below the equal lows, below the support level, to take out the liquidity that's resting below it. And then what do we see afterwards? A sharp movement in the opposite direction, a very, very strong movement in the opposite direction. After that moment, that's enough for us to sort of look at this and say, we can start looking for our mitigation area, our entry area. So Usually with my entry areas, I look at if it's in the case of consecutive candles, so consecutive manipulation candles, I'll look at obviously the first of the set of consecutive candles, and I'd be looking at the open of that, the open of the start of the consecutive, and then it'll be the last candle before the sharp move in the opposite direction. So this candle right here, I'll be looking at the wick of that candle right there. So we've got our mitigation sort of area marked out with these two blue lines, and from then on, you know, we could be starting to look at placing some of these buys. You know, it's completely up to you whether you want to be looking at placing these buys on this higher potential entry or this lower potential entry. Personally, what I do is I mark out both zones like this, and then as it gets close, I just try to market execute as it's in this area to try and give myself the best possible entry. Could be looking to target up in this imbalance up here to see how that goes. Looking to achieve a 1 to 3.8 on this trade. So as we forward the price, we can see obviously how this is going to look to play out. So as I forward the candles, you can see its price is starting to move back towards the mitigation zone. And here we go, we've got our entry triggered in, so you know, it would be entered into that position right there. And as you can see, the reaction from the close of this 15-minute candle is really good. It's a really good closure, and you know, we're closing, you know, high into our profit. We're already looking at around a 1-to-1 risk to reward ratio at this point. And then as we sort of see how things will progress, and also one thing that I just wanted to touch on is if you get a mitigation immediately after the creation of the institutional candle, that's what's known as an early mitigation. Now what this means for us is, you know, obviously if you can see this at the time and you catch the early mitigation, then that's great. You know, you'll be able to, you know, trade this pretty much after you've identified the candle. But that doesn't mean, you know, it's just going to keep going up from here. Because it is an early mitigation, what can sometimes happen is you'll get price coming back to it later on to mitigate once more from the same zone. So, you know, whether price, you know, carries on higher, comes back down to the mitigation zone, and then it will carry on going higher up. That can still sometimes happen. So as we forward the price, we can see obviously how this looks to continue. As I said, you know, it went higher a little bit, came back down, you know, to fill in any sort of inefficiencies in price. And as you can see, it's closing bullish. The close of each candle is closing very nice, very bullish. It's good price action. And as I said earlier, you notice that it's done that thing where it goes back up after the early mitigation, showing that there's strength in that move, showing that there's validity in this manipulation candle. And obviously as we see how things progress, now getting closer and closer to the mitigation zone once more. And here we are, we're entered once more. You know, if you didn't get your entry the first time, you'd be able to grab that entry a second time on that normal on the second mitigation. Really good reaction from there as well, so that's fantastic. And there we have our TP hit quite nicely right there. So now moving on to our next example, we've got Euro USD right here on the 5-minute time frame. And you know, the price action on this was actually 17th of Feb, so a lot more recently. So you guys can actually go back, like I said earlier, and you know, study these for yourselves to help you out in your analysis. So on Euro USD, we're on the 5-minute time frame here, and as you guys can see probably from the markup, we've got this area of equal highs. We've got this resistance zone. Think about the retail pattern that this looks like. You know, you've got that M pattern. It's looking like a very, you know, very clear M looking pattern, like so. So you know, you've got that M pattern that's created, and that liquidity, that zone of liquidity, that pool of money sitting, you know, above those equal highs. And you know, as price comes back to revisit this liquidity area, what can we see that's happened? On the 5-minute time frame, we've got a really nice looking buy to sell candle. We can see that it did go above those equal highs, you know, within this wick right here. So you know, we've got our mitigation sort of areas marked out. You know, we've got the wick of the institutional or manipulation candle. So we've got the buy to sell candle right there. So we're looking at one of the entries on the wick, and another one on the open of that candle. And as we sort of forward the price, we'll be able to see how the short situation would be. So obviously we'd be having our stop loss just above the high right there, having our entries in there as well, and we could be looking to target back down into this potential sell to buy region that I've analyzed previously. So obviously this is looking around a 1 to 4 risk to reward ratio to achieve on this trade, and let's forward the price to see how it progresses. So I'm just going to play price right now, and as you can see, we've got a mitigation over here. It does give a good rejection to the downside, so it's proving to you that this supply zone, this institutional candle is valid, and taking short on this sort of trade idea, this sort of scenario would be a good idea. And as it comes back up into the mitigation zone once more, it's really giving that bearish nature of price. Now usually when it comes to a trade scenario like this, where you've got multiple mitigations happening, I'd go maximum 3 mitigations before I'd look to discredit the trade idea. So if it does come back for one more mitigation and then drops, then I'd be looking to definitely moving my position to a risk-free or a reduced risk scenario, just because if you think about it, if you've got mitigations happening in a common zone, it's just another area of resistance being formed, another area of equal highs being formed. And obviously we don't want to be entering at equal highs, and essentially if we do get 3, maybe 4, maybe 5 mitigations of the same zone, we're basically doing that. So as we sort of forward price, we'll see obviously how this plays out. So it does come a bit closer, but it wouldn't have hit any sort of protective stops. In essence, it's just sort of filled in the inefficiency that existed in between here. So that's looking pretty good, and as we sort of forward the price, we'll see how this progresses. And there you go, that's that third mitigation I was talking about. So now stops would be moved lower. And definitely at this point, you're running in a lot of good profit. So you don't really want to be moving that stop too much. You want to keep it protected. The whole point of trading is to preserve your capital. And as we can see, there's a lot of consolidation in this area. It's very flat price movement, and as we can see, we start to get that bearish movement the following day. So you have to be holding this overnight, incur a little bit of swap, but by the end of it, it does move deeper into that profit. And there we go. I think that would be the final TP hit. There you go. We'd be looking to close out in that zone right there and be done with the trade. Now moving on to the next example, we're going to be looking at US 30 right now on the 5-minute time frame, and this is another sell scenario which I've got for you guys. And as you guys can see from the markup, you guys should be getting used to this now, training your eyes for these situations in the market. We've got this area of liquidity. Now the previous examples which I've shown you, the liquidity has been pretty much perfect looking, it's perfect equal highs. And like I said earlier on in the video, that's simply not going to be the case in all of the examples. The market isn't going to be perfect like that every single time. And here's an example of that. We've got the wick of this sort of candle right in here. It's not exactly lining up with the wick of this, but it's relatively close, and that's good enough, to be honest, when it comes to liquidity. So identifying liquidity, it doesn't have to be exact equal highs. So yeah, we've got this pool of liquidity, pool of money sitting here, and then we get this buy up to sell movement. And this is slightly different to the buy to sell and the sell to buys which I've been showing you beforehand. This is actually an example of a drop based drop scenario. So a redistribution scenario happening within here, which obviously causes price to go lower, and that whole manipulation was pretty much sort of facilitated by that drop based drop. So we've identified the drop based drop institutional candle right there, or manipulation candle, and we've got our mitigation sort of lined up right there. In this case, I've only got one mitigation area because it's a drop based drop, and it's pretty easy to sort of clock in this example where to place your entry. So obviously we're going to be looking at placing some sort of sells around this zone, having your stops above there, and obviously, you know, we'll be looking to take out the next low. And further on, obviously, if you've got your next pieces of analysis after that, then, you know, you'd be looking at you know, potentially taking this further as well. So, you know, I'll put this at a rough 1 to 9 or 1 to 10 risk to reward ratio, just for argument's sake, just to see if this does continue onwards. So there you go, we'll have a look at that, and let's forward the price to see you know, obviously how this trade pans out. So I'm gonna press play, and there we go. We've got a very good movement of price happening right in there. We got price coming up into our mitigation zone. And something else I just want to sort of bring up is looking at, obviously, after the buy to sell movement, what did we get created down here? There's a big degree of equal lows, a big area of liquidity sitting in this area. You know, an area where you see, you know, multiple wick rejections. So, you know, you got a wick rejection here, got a wick rejection here, wick rejection, wick rejection, wick rejection. So, you know, there's 5 different wick rejections in that area. Wick rejections usually mean, you know, that's an area of liquidity, you know, because if it's giving rejections in a common zone, they're building up liquidity on the other side of full of orders. So when they've got liquidity building up on this side as well, it just gives you that more of that confirmation that this trade is going to actually move towards you know, into your profit zones. So obviously, let's have a look how this continues on. And there we go, that's that final sort of TP hit right there. That would be a really lovely 1 to 10 risk to reward ratio trade. Really nice setup, typical sort of smart money trading setup right there. Now, the final example I've got for you guys is on GBP JPY, one of my absolute favorite pairs to trade. I'm going to show you 3 different scenarios in one actual, you know, one trading day that actually happened on this. I believe this price action was actually from yesterday, from this time of recording, so 21st of Feb was this price action I'm going to be showing you. And these are all sell scenarios, and I think one or two of them will be the scenario where you'll see the consecutive manipulation candles instead of just one single sort of block, you know, causing the manipulation like you see right here. So the first example, again, very simply, you know, we've got multiple rejections of a common zone. So, you know, you've got a rejection here, big rejection here, and another rejection here, creating that pool of liquidity, you know, above the equal highs. Also think about the retail traders. This is probably the most perfect M pattern I've seen in such a while. You know, you've got the M pattern there, and, you know, literally another rejection right here before it does that manipulation later on. And looking at our mitigation zones, we're going to be looking at, obviously, this is the candle that takes out the equal highs, that takes that liquidity, and then we've got the consequent you know, opposite move drop in the opposite direction. So looking at the mitigation, I'm looking at the, you know, the wick of the candle that took out the liquidity and the open of that same candle right there. And that's going to be obviously for the first entry. So having our entry, you know, we'll be looking at having the entry within there, stops just above the institutional manipulation candle, and we'll be looking to target, obviously from my previous analysis that I've done on this actual pair, I believe there is a demand zone down here where we can look to close off a lot of our profits in. So I'm just going to put it down to about here, which is obviously where the imbalance fill is. So looking to take this, you know, maybe a 42 pip move down. So as we've seen that, you know, and realize the main thing that I'm looking at, you know, in these scenarios is you want to see, obviously, the easy part to see is the sweep of liquidity, the, you know, the liquidity grab. So, you know, something going above equal highs or below equal lows, that's the easy part. But then a lot of people really, you know, miss out, you know, afterwards is it's that strong opposite move, you know, downwards after the liquidity capture, or obviously the move upwards if it's the other way around. We need to see that sharp opposite movement down, because that's basically telling you, you know, after we've, you know, manipulated the market, we want to be showing our direction, our true direction of the market. And, you know, they show that by obviously, you know, breaking structure to the downside in this case, below this point. If you want a refresher on obviously market structure and you know, breaks of structure, changes of you know, momentum, then please do have a look at that previous video that I've recorded. I'll put the link in the description as well for that. But yeah, there we go. We've got this sort of sell scenario panned out. So we're going to see how it looks to play out. And as we see price forward, you know, we've got really good movement up into the zone. It does come up fairly strongly, as you guys can see. You know, what does it actually do on the approach of this zone? Realize what's happening over here with this wick right here. You know, it almost got to that mitigation zone. You know, we could have called that, you know, our early mitigation had it have reached, you know, the candle. But in essence, it didn't quite reach it, and essentially it just built up liquidity. Now, obviously on the 1 minute time frame, it's hard to see, you know, multiple rejections in the same zone in one wick. You know, if you were maybe to go down into a lower time frame, maybe into something like you know, a 30-second or 15-second time frame, then you'll be able to see, you know, there may be potentially some multiple rejections in this area. But usually, you know, sometimes with the wick, you know, we can sometimes call that a resting liquidity zone as well. So, you know, there's liquidity sitting above here. And, you know, usually on my analysis on my charts, I'll just sort of depict the liquidity with, you know, some dollar signs or some pound signs. So, you know, you've got even more liquidity sitting up here, and that's in line with your previous manipulation candle. You know, that should be, you know, a couple different sort of confirmations sort of aligning up with each other and giving you that confidence. And as you can see, as it gets up into the mitigation zone, it clears this little piece of resting liquidity out, and we get the fast move in the opposite direction as well. So as we sort of forward the price and sort of see how this looks to continue, and I'm going to stop it about there, because what we've got here is another sort of example which I was going to show you guys. Again, same sort of thing. You know, we've got our liquidity zone here. It's not perfect, you know, it's not perfect rejection, but what you guys can see is, you know, it's relatively close. You know, you got multiple rejections in this area, and then we get the price moving up into this area. We get a liquidity capture and a sharp move in the opposite direction that does break structure to go, you know, create a further lower low. So that's all good to see. Now, next, what we're going to be having to look at is obviously the approach up to the mitigation zone, and in this case I've just put the mitigation at the open of the candle right there. So we'll have a look at obviously entering right there and having, you know, stop losses just above the institutional manipulational candle right there, and you know, we could be looking to target that same sort of area down below. So around there be another little 1 to 10, 1 to 11 trade. You know, and of course, as you start to enter more sell positions, you want to be, you know, decreasing your risk on positions you may already be in. So in this potential scenario, had you have got into this first trade and seen an opportunity for a second trade, you know, you'd be looking at reducing your risk, or maybe even moving it to a risk-free position, so moving your stop loss into your profit. So let's see how this potential entry would have panned out. And as we can see, price gets entered right there in that candle right there. I'm going to move this along so obviously we can see it right there. And let's obviously see how this progresses. Great rejection from the zone right there, and you guys can probably see why I favored GBP, JPY, and, you know, stuff like US30 as my favorite pairs, because it moves so well with smart money concepts. You know, it shows you where the liquidity is very well, it shows you where the manipulations are well. It's fairly, you know, fairly simple, fairly concise to grab these mitigation entries just like this. So yeah, let's see obviously how this continues onwards, and we can go on to that last and final example. And there we go. Like I said earlier, with that resting piece of liquidity up here, we had the early mitigation, and then the liquidity is still sitting above there, and then, you know, it coming later on to take that out, getting into the manipulation zone and dropping it. And in this case, what have we got? We've got the exact same sort of thing. You know, we've got this mitigation here with liquidity sitting above it. We then get this candle right in here, pushes up very high strongly into that candle, and obviously we're about to see if it's going to be rejecting to the downside or not, see if we're correct in our analysis. And there we go, we've got a really nice, you know, rejection down. And again, it's the same sort of thing. In this case right here, this is a scenario where we've got, you know, 3 consecutive bullish candles that took liquidity out up here, and followed by a massive drop in the opposite direction. So this is an example of the institutional manipulation candle that has 3 consecutive candles. And obviously in the case of 3 consecutive candles, I'll put one entry at the open of the bottommost, the first candle in the set of consecutive candles, and one at the wick of that last buy to sell candle, giving us our rough entry area. Again, we're going to have a look at how this looks to play out. Having entry in there, stop loss again just about here, just above that manipulation candle, and again we're looking at taking profit, that exact same area, same TP. Let's see how price continues. So right there, we've got our strong move down, that's broken structure, so probably now we should have been looking at taking the entry. I was probably looking a bit too early right there, but obviously it's all good to see in hindsight and backtesting and stuff. Let's see obviously how this plays out. There we go, it's getting into the entry zone right there. It actually got into the top entry zone, so it could have probably had a potentially better entry than that, but we're still good. And we're going to have a look at obviously how this plays out. And there we go, we've got it making further lower lows, and it's racing away to that TP. And let's just finish it off to see if it does reach it. So you may have been broken even on that third entry right there, as it comes back up, but around this sort of zone, when it's this close to your TP, it'd be pretty foolish not to take profits on any 3 of these positions. But yeah, as we can see, we had a really good movement of price until that TP, and then just realize what's happened again. We've got liquidity, we've got the sell to buy movement happening again, but we are in downtrend, but we can see a buying potential opportunity. So I'd take that buy with a pinch of salt, because obviously we want to always be trading with the trend, and we'll see how price develops after that. And there you go, that's why I took it with a pinch of salt, because it did get clapped, and price did eventually go further to the downside. So that brings us nicely to the end of the video. I hope you guys not only enjoyed it, but also took some value and learned something from it as well. Now, if you did, please do give it a like, it means a lot to me. Please share it with your fellow traders, and please do subscribe if you're new around here. Also, let me know in the comments what you guys think of the new video layout and the editing. Let me know if you like the new thumbnail and the video design and all that sort of stuff. That would be very helpful for me, and I'd appreciate it a lot. But yeah, thanks for watching guys, and I'll see you guys in the next video for more of that trading sauce.